Welcome back to the Wall Street Podcast. Today, we're doing a deep dive into the latest from Barron's. We're looking at the July 21, 2025 issue, volume CV, number 29, published by Dow Jones. Now, our mission for you, our highly knowledgeable and frankly time-sensitive listener, is to pull out the most critical pieces of information. We really aim to cut through the noise, deliver actionable insights on market moves, economic trends, basically a shortcut to being fully informed.
Exactly. And in this deep dive, we'll be looking at how policy might be, shaping market bubbles. We'll also touch on the banking sector's health, which is surprisingly robust, though there's caution, plus some overlooked opportunities in essential services and how investor demographics are shifting, all distilled down for you.
Great. Okay, let's start by unpacking that intersection of policy and market performance. President Trump's economic influence, as Barron's covers it.
Right. So the article Up and Down Wall Street, in service of big tech, that's on page 4, it highlights how certain Trump policies could be seen as, well, inflating the current AI tech bubble. Things like relaxing chip export rules to China and the new tax bill allowing immediate expensing for domestic R&D. These give a direct boost. And you see in the numbers, the technology select sector, SPDR, ETF, it surged 35% in just 3 months.
35%. Wow.
Significantly outpacing the S&P 500's 19% rise over that same time. And what's really interesting, UBS strategist Andrew Garthwaite has this 7-point bubble checklist.
Okay.
6 points are apparently already ticked off. The final piece. That's benign monetary conditions, meaning Fed rate cuts, and those are anticipated by year-end.
6 out of 7 already checked.
Yeah.
That is a stark picture. So what does that really mean if the market, especially tech, keeps climbing despite these classic bubble signs? Is this AI surge just different somehow?
Well, it strongly suggests we're in a highly speculative phase, doesn't it? Where the story, the narrative, often runs ahead of the fundamentals. And here's where it gets kind of paradoxical. The article points out that while trade policies might weaken the dollar, this actually benefits the tech sector. Because tech giants make about, 55% of their revenue overseas? So a weaker dollar means those foreign earnings translate into more U.S. dollars. It could potentially add, say, 2 percentage points to S&P 500 earnings in Q2.
Huh. That is counterintuitive.
Isn't it?
It really is. Okay, so that discussion on policy's market impact flows nicely into another area of government influence, the national debt. Barron's digs into this in a reality check for the king of debt on page 46.
Yes. President Trump made the claim that the Fed's interest rate policy is costing the U.S. hundreds of billions a year in refinancing its massive $36.6 trillion national debt. But Alan Sloan's analysis in Barron's offers let's say, a crucial reality check.
Okay, what's the reality?
The Fed primarily influences short-term rates. That only affects about $5.78 trillion in Treasury bills. The vast majority of the publicly traded debt is actually longer-term Treasury notes. That's around $15 trillion in bonds, another $5 trillion or so. And those have an average interest rate of about 3.3%. So the idea that Fed rate hikes are immediately costing hundreds of billions in refinancing, well, the math doesn't really hold up like that.
Right, that's a really important distinction. So if the direct impact isn't what was claimed, what are the real implications of rising rates on that huge debt pile? And how does this all link to bigger fiscal challenges, like, say, Social Security?
It connects directly. That leads us into the discussion in Social Security cuts ahead on page 47. The Social Security Trust Fund. Its depletion date has been pulled forward. It's now projected to run out in 2033.
2033, that's 9 months sooner than they thought before?
Exactly. And part of that acceleration is due to lower revenue, estimated at about $30 billion less per year. This stems from making the 2017 tax rate cuts permanent and adding new senior deductions under the recent tax law. It all comes back to fiscal sustainability, you see.
That does sound pretty grim, but what should someone nearing retirement take away from this? Should pre-retirees be, rushing to claim benefits early?
That's the critical question, isn't it? And the guidance seems clear. No, rushing to claim is generally not the best move. Even if the trust fund technically depletes, the incoming payroll taxes are still expected to cover about 75% of the promised benefits. And for most people, waiting longer to claim, maybe up to age 70, still results in significantly higher lifetime benefits overall.
Okay, so patience is still key, but it underscores the need for personal planning.
Absolutely. It signals a bigger shift towards individuals needing robust personal savings strategies, rather than solely relying on state benefits down the line.
Got it. Okay, let's shift from the macro view of policy and debt now. Let's zoom in on specific sectors. I'm curious about some of the maybe unexpected success stories out there. What caught your eye first?
Let's look at the banks. Bank earnings paint a fairly rosy picture. on page 8, sums up the Q2 earnings for the big players. JP Morgan, BofA, Citi, Wells Fargo, Goldman, Morgan Stanley. And the picture, mostly better than expected. Higher profits year over year for most.
Really? What's driving that?
Underlying strength seems to be consumer credit. Yeah. It's generally healthy. Delinquency rates are low. That's supported by a strong labor market, 4.1% unemployment.
That does sound surprisingly strong, considering all the talk of economic uncertainty. Were the bank execs flagging any concerns, though? Any clouds on the horizon?
Oh, absolutely. It's rosy, but with a dose of caution. Executives did raise concerns, weaknesses in commercial real estate loan portfolios, for example, and potential future hits from tariffs. So it's definitely a cautious optimism. They see the current strengths, but also the potential bumps ahead.
Right, makes sense. Okay, that brings us to a sector that, well, it often flies under the radar, but seems to have delivered really impressive returns. Waste haulers. Streetwise. Cashing in with trash haulers on page 6 explores this.
Yes, this is a fascinating one. It's seen as a defensive business, right? Reliable cash flows and the long-term returns. Pretty compelling. Waste management returned 462% over the past decade. Republic Services, 602%. Compare that to the S&P 500's 253%.
Wow, that's significant outperformance. What's the key driver there?
A big factor is tightening landfill capacity. It's projected that nearly half, 594 out of 265 landfills, could close by 2050. This gives the big, vertically integrated players like Waste Management, they handle about 28% of U.S. landfill volume, and Republic Services, with around 20% considerable pricing power.
So it's a classic supply-demand story creating a strong competitive moat. But isn't waste management sort of a low-tech business? Is technology playing any role here?
But that's where it gets interesting again. AI is making a difference. AI-enabled sorting facilities are making recycling much more profitable now. Sometimes, believe it or not, even more profitable than the landfill side in terms of free cash flow margins.
Really? AI in recycling?
Yes. It creates new growth avenues and gives these companies a real competitive edge. It's fundamentally changing the economics of a business many might see as, well, mundane.
Okay, shifting gears completely now to a challenge in the digital world. Counterfeit goods. Barron's highlights this in AI is making buyer beware even harder on page 10. How's this problem evolving?
Well, counterfeiters have largely moved. They've migrated away from traditional e-commerce sites like Amazon and eBay, which have gotten better at policing.
Yeah.
Now they're increasingly on social media platforms, Facebook, TikTok, WhatsApp. These platforms have, historically at least, been less aggressive about fake goods.
And the scale of this problem.
It's alarming. The volume of seized goods for IP violations more than doubled between fiscal 2020 and 2024. And the value, the MSRP, of those seized goods jumped 95% in 2024 alone. There was a survey in 2023. It found 68% of consumers said they were tricked into buying counterfeits through Facebook.
68%? That's huge. So what's stopping these platforms from doing more? Is the law catching up at all?
That's the tricky part. There are legal gaps, you could say. Current U.S. counterfeiting laws mostly target the manufacturers and sellers, not necessarily the platforms facilitating the sales. So enforcement is inconsistent. Even newer laws like the 2023 Integrity Act, they seem to lack strong enforcement teeth.
So little accountability for the platforms themselves.
Largely, yes. But the legal landscape might be shifting. There are potential court decisions on the horizon cases like Anderson v. TikTok and Moody v. NetChoice. These could potentially reclassify algorithm-pushed content as first-party platform speech.
Okay, what would that mean?
It's a crucial legal distinction. If that happens, it could seriously reduce the platform's immunity under Section 230 and increase their liability for this kind of illicit activity. So definitely something to watch.
Absolutely. Okay, let's pivot now. We want to tie some of these insights together with 3 key questions for you, our informed investor. Question 1, given all these mixed signals in the market, where might the most undervalued opportunity lie right now?
That's a great question. Look, the S&P 500 and NASDAQ hitting records is true, but that strength is really concentrated in just a handful of tech giants. This creates what we call a breadth problem. Most stocks are actually underperforming the main indices. It's a narrow rally.
Right, driven by just a few names.
Exactly. And consider this. The S&P 500's earnings yield is currently about 4.3%. That's now less than the guaranteed 4.4% you can get on a 10-year treasury.
So bonds look relatively attractive compared to equities based on that metric.
Precisely. It suggests bonds are quite attractively valued right now, particularly active bond funds. especially those with flexible mandates, ones that can invest in things like securitized consumer loans, pools of car loans or credit card debt,
Mm.
or maybe emerging market bonds. These funds are currently offering yields in the 6% to 7% range. In this kind of nervous equity market with narrowing breadth, these active bond funds offer a really strategic way to capitalize on those attractive bond valuations.
Interesting. So amidst the tech hype, maybe look towards actively managed bonds.
Got it.
Okay, second question. How are demographic shifts, specifically looking at women investors, reshaping investment strategies, and even outcomes?
This is a really significant trend Barron's highlights. They
Hmm.
talk about a gender neutralization in investing, and it's largely driven by younger women. The data is pretty stark. 71% of women were invested in the stock market in 2024, up from 60% just the year before in 2023.
That's a huge jump in 1 year.
It is. And they're not just participating more, they're taking more calculated risks. There was a Wells Fargo study. It found that accounts managed by women actually outperform those managed by men, both in absolute terms and on a risk-adjusted basis.
Really? Why is that?
Well, the study attributed it to factors like a more disciplined approach, patience, and perhaps a greater willingness to seek professional advice. And the impact. It's dramatically narrowing the retirement savings gap. Get this. Gen Z women's retirement balances are already at 98% of their male counterparts.
98% for Gen Z. That's incredible.
It shows a powerful and likely lasting demographic shift in wealth management.
Truly powerful. Okay, final question. Looking beyond the immediate buzz, what fundamental shifts are creating new, durable competitive advantages, those moats, and shaping investment narratives for the long haul?
I think we see two crucial shifts creating these lasting moats. First, AI's impact goes way beyond just the big tech companies. Think about agriculture. Precision farming, using AI tools, say from companies like Deere, can potentially boost crop yields by 20% a year. That could add something like $13 billion to U.S. farmers' profits.
Oh, AI in farming.
Exactly. And
Massive.
similarly, think about the huge power demands of AI data centers.
Yeah.
That's driving massive growth for companies like GE Vernova, which makes gas turbines for power generation. They have something like a $60 billion backlog.
So AI's ripple effect is creating opportunities far beyond software.
Definitely. The second shift is the reinforcement of moats around essential infrastructure and services. We talked about waste
It's
haulers.
the landfill capacity issue.
Yes, rising costs, limited capacity that creates strong, predictable cash flow. But also think about companies like Union Pacific, the railroad. They benefit from industrial production, high barriers to entry. These are financially robust businesses built for the long term. These foundational shifts are where lasting value is often built.
That makes a lot of sense. Well, we've certainly covered a lot of ground today, from policy impacts on bubbles and debt to the surprising health of banks, those hidden gems in waste management, the challenges of digital counterfeits, and that really transformative role of women in investing.
And that's really the goal of the deep dive, isn't it? That help you connect these seemingly separate pieces to see how they fit together into a cohesive, informed perspective.
To help you see that bigger picture more clearly. So here's a final thought for you. As AI continues to reshape entire industries and fundamentally redefine productivity, ask yourself, how will this massive shift impact the traditional ways we measure market value? And what new metrics might emerge for investors like you to truly gauge long-term potential in this new era? Until next time.